Hi, my name's Jared Broad from QuantConnect, and in today's episode of Idea Streams, I wanted to look into the US initial jobless claims and the US unemployment rate and see if there's some sort of factor that we could tie to the US market overall. So as always with Idea Streams, this is going to be fairly raw. We're going to be coding along the way and trying to show you the process of debugging and working through a strategy. So first, the idea really came from a number of news articles lately that seem to be indicating that we're headed for about 16 to 20% unemployment rate, and these are levels really not seen since the Great Depression of the 1930s. So this is being written about because the normal initial claims, the initial unemployment filings are around 200,000 to 300,000 a month. And in the last 3 weeks alone, we've seen 4 million, 6.6 million, and 6 million initial claims for unemployment. So it's really a record-breaking, off-the-chart sort of change due to the coronavirus's impact. People are wondering why the stock market is rallying and trying to understand this, so we thought we'd have a look into it and see what we could see. To start, we're actually going to start from a little bit of a prototype, a template. This is just a research notebook where we're importing trading economics data and adding in US equity SPY data, and then getting both of those data sets and performing a linear regression on them. So this is using SKLearn's linear model, and we're going to be working with this research for a little bit and then trying to build this algorithm in a QuantConnect framework style. So firstly, let's just step through these. So we've added in here an alternative data source that QuantConnect supports, trading economics, and that's just automatically shown up here, and then we can just run through and it'll pull down the history for both those unemployment figures and the S&P 500 in this case. So here in this data, we're joining the two of those numbers together because the unemployment numbers are, in this case, monthly unemployment rates for the entire country versus the S&P, which is the daily SPY close price. And so we need to do a little bit of manipulation to get that into a place where we can compare the two numbers. So here with linear regression, you need to do a training set and a test set. So we've split the data set up into this train and test data set. And here we've chosen the most recent 5 values as our test, and everything else has gone into the training set. So you can see we've split the array into these two pieces and then saved them to the different variables and then performing the linear regression here. So there's a few little bugs there that we can tidy up. Cool. The first thing to note is that just by doing the simple linear regression, we're getting a 0.9 R-squared value. Linear regression is really just simply drawing a line through a series of 2 points, two data sets. So here we're saying that with 0.9 R-squared, we can predict the close price of the S&P by the unemployment rate in the training data set. So then down here, the next part is how did we perform on those most recent 5 data points? And you can see here that we've actually performed fairly poorly. An R-squared of less than 0.7 is almost meaningless. Here we've got a negative R-squared, so who knows what that means. So then just doing some simple plotting to visualize it, you can see it's a quite nice correlation there with a linear mapping. And then here is just the training data set. And then you can see here the training set in orange and then the test set in blue. So you can see how the test data set is deviating from that linear gradient. In recent history, we've seen a plateau. So if you look back at unemployment numbers in 2007, 2008, it sort of peaked at about 9 or 10%, and then since then it's been going down pretty steadily. So it almost makes sense that we would see a plateau. If you were to think about it would be kind of easiest to get half the population working and then a little bit harder to get the next quarter, and then a little bit harder to get the next 10% of the population working. So it gets harder and harder to get all the way down to 100%. So it makes sense that we would see this sort of gradual plateau, and that perhaps this isn't the best model for a relationship like this, and that we should choose a curved relationship, like a x squared or something. But for now, as a simple way to experiment and play with the data, we're going to use this linear model. The first point of difference that we want to point out from this is that this is using the unemployment rate and not the US initial claims. People file for unemployment and then they go through a process of whether or not they're approved. And so we actually want to look at the actual initial claims numbers. And so we can import that as a custom data set into QuantConnect. So there's a fairly good source here, the Fred, and you can find unemployment. You can find the unemployment rate here, and then somewhere here there's the initial claims. So here you can see it's a weekly number, and let's use the seasonally adjusted version. And so the only things to really note is to get a general sense of the data before we pull it in. You can see here the unemployment rate goes back to the 1950s. It's monthly. You can see here that the March 2020 rate was 4.4, and we can see that little spike here at the very end of the curve. And then otherwise it's a generally decreasing curve. You also want to pay attention here that the date that this number was updated was April 3rd. So this is the unemployment rate for March appeared on April 3rd. Okay, and then looking at the initial claims number, we can see some pretty crazy behavior here. It's a pretty smooth figure, and it peaked at about 600,000 in the peak of the crisis. And then we see these numbers here due to the coronavirus. We're seeing spikes of 3, 6, 4 million per week filed. So it's really an extraordinary situation, and we are doing our best to try and understand this, but it might not map to any sort of traditional models because it is so far out of what we can expect and that we've ever seen before. Let's download them. So let's download the CSVs, and then we can import these as data sets to QuantConnect. So the good thing about the research environment is that you actually can treat it just like an algorithm. We can import custom data types, we can run history requests on them, just everything like we would with an algorithm. First, let's find an example of custom data in Python that we can copy from. And so here's a simple algorithm importing Nifty data, the Indian stock market index. So let's copy this. Okay, so we want to try and import the unemployment rate and the jobless numbers here. So let's see if we can add this type, and we'll name it the same as the Fred. So we can delete some of these comments, and although in this case it's got a try and catch, I generally try and avoid putting try catches into code because you can hide bugs and end up spending hours and hours and hours debugging things that you're actually just ignoring. So let's get rid of those. So we're going to put these into our Dropbox. And so we've got here the initial claim seasonally adjusted and the unemployment rate there. So let's copy this Dropbox link. We'll come back to that in a minute. Okay, and then the first thing you want to do here is always remember to change it to download equals 1, because that'll be a hard error to debug. Dropbox allows you to directly download the file, so we can just set that here. And then we probably want to get a feel for the data. What does this look like? So you can see here we've got year, month, day, and then the unemployment rate. So let's zoom forward, and we can see this 3% unemployment, and then the spike up to 4.4 here. Just at the, it's reporting it as the start of March. So we'll parse the time here, and then the value of unemployment is there, this column. Okay. So that's about all we need to do to get the bare bones of the data in. The first thing you want to try and do is remember that when you're importing an alternative data set that from Dropbox or something like that, you are almost implicitly accepting responsibility for look-ahead bias, and you've got to be very careful. So in this case, we noted that it was a March unemployment number, but it didn't appear until April 3rd. And the dates on the file were for the beginning of March. So the first thing we want to do is adjust that at least from the 1st of March all the way up to the 3rd of April. So let's do that here on this date time object. We'll just add 31 or 32 days to the date, and that should be safe enough to get us into the right area. Say 32 days to be safe. And then here we have a data source imported from an external site, and it should be safe enough for us to use. So then we just need to add the data. Cool. So this should be enough. This will import the data for us and add it here so that we can access it with the symbol rate. So let's tweak these. We have here unemployment, and maybe just for simplicity, let's set that to unemployment so that we can reuse this code. Oh, there we go. So the trading economics used this actual, and we've named our data source here value. So change this to value, rerun it, and it looks okay. Great thing about research is that you can just do a quick printout to see if the numbers are as you expect, which is good. You can see here it's a monthly number, so we only have these 5.4 numbers here on the start of every month, which is good. And then this last part here is going to join that S&P 500 and the newly imported unemployment rate together so that we can see them side by side. So this is a very fast way of doing linear regression. You can see it's come out to roughly the same number. Presumably that has something to do with the release dates, and we've got an estimate here of about 0.91 R-squared on our training set. And let's fix this little capitalization bug. Cool. On the test set, we actually have 0.6. which is a reasonable, it's not negative. It's not great, but it's not negative. So then we'll have a look here at the plot. So we can see the same plot information and see our training and our test set here. And then we can see the unemployment rate and the S&P 500 price. So now we've got a reasonable framework. We've imported our first data set. Let's repeat it, but repeat it with the claims number. So we'll copy paste this one. And now we need to import these claims, ICSA. And let's have a look at the data itself. Okay, this is roughly the same format. Year, month, day, and then the claims number we can see as we were discussing, roughly 200,000 to 300,000 per week. And then here in the last few weeks, we're seeing millions of initial claims. So let's import this number in and see how it looks. First, we copy the Dropbox link, and then we can paste this in here. Remember to change the download link. Okay, and then we add the claims. When you copy and paste something like this, it's really important to read it very closely because there's almost always a bug. Oh, here we go. There's a bug. So with the offset, we need to make sure that we're offsetting it the right way for each data source that we're importing. So here we're seeing this was updated on the 23rd and it was an observation from the 18th. So we have a 5-day delay there. So let's add 5 or 6 to be safe. And do we have the right offset for this claims figure? Okay. Now, let's copy this. I'm going to repeat it with claims. Okay, that looks good. Let's see what the claims numbers are. Okay, that's perfect as we were expecting every week with roughly 200,000. Okay, so we can use that. As before, we join it to SPI. And because we use the same properties here, we actually don't need to change the regression here at all. We can just run it through. Let's double check this. No, that didn't update yet. There we go. SPI close. So we want employment numbers, claim numbers. We do need to update it. There we go. So now we have the SPI close and the unemployment numbers tied together. So that's good. And we should see, there you go, a little bit of difference. So now we've done the linear regression to fit the jobless claims numbers to the SPI to experiment to see if there's any sort of relationship. We saw the R-squared decrease. So this means that the relationship is weaker than the overall unemployment rate. And so we can run that on the out of sample and we see a really bad fit for the test set, much worse than it was before. So that just means that it doesn't mean very much, actually. So the last 5 data points for the weekly claims are way off the record of what anybody has ever seen before. So the fact that the linear regression model doesn't fit to them very well is not unexpected. So we'll just leave that as a observation and we can plot it and see the general trend here is going up with it, but relatively weak. And then in recent times it's deviated significantly, and then you have these outliers from the current environment. So you can see here these outliers. It's actually the last few weeks have resulted in predictions of negative $10,000 for the S&P. So those are, way off the charts of this sort of relationship. But otherwise, you can see that it's because of these outliers there, it's almost impossible to read the predictions. So one of the things that I noted in one of the articles is that it said that the broader market was being held up by Apple, Microsoft, and a few tech companies. And that kind of makes sense that the larger companies with more cash on their balance sheets would be better handled to weather a recession, and that investors might have a kind of flight to safety to move out of stocks which have a relatively worse off position and move into ones with a relatively strong position. To look at that, let's just take a quick look at the general recovery of a company like Apple. If you see here, we had a peak of 324, 325, and then now we're at 280. So 325 minus 280, 280. So 45 divided by 325. So Apple is only 13% down from its peak, and relative to the overall market, I think it's doing better than even the overall market, I think, which is SPY is at so here we've got the general overall market. We've got 338 down to 286. So 52 over 338. We're down 15%. So one way to test this theory, if it is that the smaller caps have been harder hit, is we can actually look at, say, for example, a small cap ETF. So here is the Vanguard one, and this one presumably has been harder hit. So we can see here it's peaking at 170 and we're at 129. So okay, and then so we're still down 24% since this peak. So it kind of makes sense. We've got companies which are smaller, they have less on their balance sheet to be able to weather this sort of thing, and they're more susceptible to a sales pressure, and so they haven't recovered quite as well. So let's test that theory on our model and see if we get slightly better fits to the data. So here we're just using SPY. Let's pull in VB. We'll just call this equity. And SPY. Equity. There we go. It's always a copy and paste error. Okay, there we go. So now we've got the equity history and the equity closes, and we can run the unemployment numbers. We didn't define this one here, so we need to actually make sure we add it. Okay, so we'll join it to the unemployment numbers and run the regression. Okay, so we get a relatively close fit on the training set, and we get a relatively close fit on the test set. So this is still a horrible R squared in any other circumstance, but considering the degree to which the numbers are outside the norm, it's actually not bad. So run through the charts. We can see here the test set lining up. Just out of interest, let's see how sensitive this is to this offset. Let's set 31. So you can see here that it's 0.86, and then our test set got substantially better, about 0.2 in R squared value. So it's a little bit sensitive to the exact offset. So if we were to do this perfectly, we would probably want to actually go and get all of the release dates of those unemployment figures to know exactly how well this predicts it. But at the moment, we're seeing that it's positive. So it's at least in the right order of magnitude, and it's good enough for us to continue building off for the backtesting and for the experimenting. We see a relatively good fit in training and in test for the small cap stocks. So let's move to building this in a framework algorithm. So first we'll run this since, say, 2005, 2004. The VB ETF was listed in 2004, so you can run it through the 2007 crash. And then we're going to need to add in an alpha model that uses this unemployment, and then a universe and all the rest of the basic models. So we can go to the documentation for those. And we're literally just going to be doing a single asset universe here. So what I would recommend if you were doing this at home, you would actually use the Morningstar small cap universe. So inside QuantConnect, we have a bunch of framework modules that you can just go and pull in, and they are kind of default template implementations of pulling in using Morningstar data, selecting the fundamental small cap boxed stocks, and that way you wouldn't have it be prone to a single ETF. So here though, just for speed, we're going to be doing this, and then we want a daily resolution algorithm so we can do some quick tests. Okay, now let's import the rest of the basic stuff. We want an equal weighting portfolio construction model. And immediate execution here. And we don't need any risk management on this strategy yet. So the key here is going to be our alpha model. So let's add in the alpha model. We're going to have here unemployment rate alpha, and we need to create this class. So again, I don't like remembering the exact methods you need to overload, so you can just copy and paste the structure in and make sure to replace the class name and pass. So if you were doing the, for example, the Morningstar universe, you would have a list of security changes coming in here, and that's covered in Bootcamp. You can go and check out Bootcamp to see how that's done, and you can see all of those securities coming in and then emit insights for those specific small cap stocks. So let's create a constructor that we're going to do some work in. And right, so first we're going to import the data. And if you remember, the jobless claims number had a weaker correlation than the overall unemployment number. So let's stick with using the overall unemployment because it might be slightly less sensitive to shocks and result in a better R squared. So here we can add in our custom data type. This should be all we need to do there. For the most part, you should be able to copy and paste from research to your algorithm. So because this is a data set specifically related to an alpha, I highly recommend that you do something like this and add the data set inside your alpha, and that way it's all self-contained. So in research, we didn't really care if it was, we didn't need to specify anything here. But in backtest, you might want to specify that this is a resolution daily, just because it defaults to minutely. And so if you have any sort of minutely data, it'll copy it forward, and that will slow your algorithm down a little bit. So it's best to somehow set the expectation of what the resolution should be. In this case, it's actually monthly, but daily is close enough. And so we'll get a new data point as soon as there is a day. So one other thing we might want to do is to set this as a not fill forward data source. So we only want this to trigger when there is a new data point that's come from the thread. So let's look that up. Setting non-fill forward on a custom data source might not be in the documentation. So yeah, need to fix that one. So first you can come here, and if you look in Lean under the algorithm folder, this is the QC algorithm base class where all of Lean extends from. So then under the algorithm here, you can see QC algorithm plotting, QC algorithm history, and then because this is a Python algorithm, there are certain wrappers that work underneath the surface. So QuantConnect is a C-based engine for speed, and we load all the data and do all the synchronization and processing in C. And then there's a communication layer that goes into Python. And then this communication layer lets you work in native Python. You can do machine learning, and then it goes back into C to send the orders and route the stuff to the brokerages. Here in this wrapper, we have some methods where we port between C and Python. So here you can see this is add data with a custom type, and we have here ticker and resolution, and then here is the fill forward, the time zone, fill forward, and leverage. So if we just pass in null, false, and 1, we should be covered. So of course there is no null in Python, there's none. And fill forward, false, like that. So it looks like the default was actually false. So we might not have needed to do anything. It might have just been fine. So that's good. But we'll leave it there anyway. Okay, so we've added our custom data source. What could we do for this alpha? So the thing with a linear regression is that you're using the unemployment rate to predict the SPY closing price today. So it's really not a long-term prediction, it's just trying to explain a one-to-one relationship. So there's no implicit prediction about the future there. And actually, if you really think about it, the unemployment rate is almost a lagging indicator, because by the time that the unemployment rate is updated, the companies have already laid off staff. So perhaps a better way to think about this, if we had the data, would be, say, to look at the sales that companies were making. And if we started to see the sales decline, we could use it as a prediction of where the market would go in the future. So just for the sake of simplicity and to complete the research, continue using purely unemployment. But if you look into what leading quant firms are doing, they're looking into the sales figures from companies, the foot traffic around the stores where the companies are selling to try and predict the sales for that company. So it's truly a lagging indicator. But in our case, since we're doing such a very long-term algorithm, it might be fine. And maybe here we could just say if the unemployment rate gets better, as in it goes down, then we'll stay invested. And if the unemployment rate gets worse, then we'll exit the market until it gets better. So to do that, we would do something here. And we would need to look to see if the data is in the slice. So you always want to check, make sure you have the data there. And then one nice code pattern they should try and use is, instead of adding unnecessary indentation, just do the inverse. So in this case, we can just return here an empty array, because if we don't have the unemployment rate, and we're returning an empty array because this is expecting an empty array of insights. So we need to return not just null here. So we could say if the slice rate is less than last if the slice rate is less than the last rate, then append an up insight and then return. So let's create an insight here going up for the month. This is a horrible hack. You should be using the securities changed collection here to build a list of securities and then emit an up insight for the collection. But we're just going to hack it for the demo. Yeah, we'll do days here. So these are trading days. So 22 would be 1 month, and that would be the length of the unemployment rate data that we have. And then let's emit an up direction for that one. Oh, no, here this is not initialized, and then also we have to set it once we've got the last rate. So here, last rate equals slice rate. So we'll save that rate value. So if you remember down here, we created this value property. So we need to refer to it here. And this is the last rate number here that we're going to be saving. So we should be able to compare those two. But this hasn't been initialized yet, so we need to initialize it somewhere. We'll set it to an arbitrary number for now, just to get it building, and we'll come back and tweak this. It's always nice to make sure that your algorithm starts fully formed and ready to go. You don't want to have an algorithm that has to wait months in order to be ready. So in this case, if we were to just do it online and not initialize this, then we would actually do something here that, like, if the rate is 0, set the rate and return and ignore that month. And it would literally take 2 months to initialize, but we'll come back to that in a second. Okay. So here we needed to add custom data to the algorithm. So I just typed in algorithm. That's not there yet. So we need to pass in the algorithm. And then up here, this is just self. So this is the context of the QC algorithm so that we can get the API methods. Let's run that and see how it goes. Oh, so it's saying here, if not, slice contains key, but then I just did this. So by default, when you do add data or add equity, it returns the security object. So if you want just the symbol so that you can do contains key and use it as a symbol, you need to put the dot symbol there. Cool. So it looks like we're emitting insights. It looks like it set out the period of 2008, 2009. And then we have a few periods here where the numbers were very small. 3.5%, 3.4%, and it set out a few of those months as well. And then in the last couple of months, we've seen this crash, and now it looks like it's setting out this month as well. So that's working as expected. Let's go back and polish up one more thing, and then also get a benchmark, because we have no idea if this is better or worse than the basic equity itself. First, let's initialize this. So starting with 0 is arbitrary and risky, because you could actually be making investment decisions here. So it's just like the previous research. let's pull this in here. We don't use QB here, we would use the algorithm. And we're not quite doing the same thing as before. But we just want 35 days. And let's see what this gets us. So then if you need to debug it like this, you should use the debugger, honestly. We'll just run a quick back test to test it. Okay. If this doesn't immediately work, we'll use the debugger. Okay, cool. So that came back through an error. Let's it's not defined. Call it rate. Come here, employment, and retry. Cool. You can see here it did fetch the last 35 days. We probably can drop these and then just take the first one, I think. So and drop in a, sorry, not an. Cool, so we can probably just use the same history, drop the NAs, and rerun the backtest, and hopefully that's it. Check out the bug messages for the output. Nice, 5.4. Great, so this is the number here at the very start of the backtest, and we've gone back in time and we've got the first number, and so we can successfully set that to the last rate, so that we can initialize our algorithm and not wait a whole 2 months anyway, for the first trade. At the moment, actually, this will still wait a whole month. And what you might actually want to do, though I think is beyond the scope of this quick tutorial, would be to actually request 2 months of history and then watch to see if the unemployment rate has dropped or risen, and use that to determine your opening portfolio positions. Let's run that and get our happy case. Okay, great. So it looks like we've traded off the bat and we have an algorithm. That's our test case. So let's make a quick benchmark and then compare these two. So for our benchmark, we can just use VB, the actual small cap ETF. I don't think we need anything else there. And start date was 2005. And so it's simple. basically just a buy and hold of the underlying small cap ETF, and that can be a reasonable benchmark in terms of drawdown and Sharpe to see how the underlying asset performed and see if we added any performance to it. Okay, great. That looks about what we expect. So you can see a drawdown of 60%. Oof. Sharpe ratio of 0.37. And for our algorithm, we're seeing a drawdown of 44%. Our Sharpe ratio is actually slightly worse. Interesting. Relative to the benchmark, it's just a little bit worse. And yeah, and standard deviations a little bit less, which is great. And yeah, it's a lot more active than simply buying the benchmark, but it did seem to step out of 2008, and it is saying interesting things at the moment, so we'll see. Okay, well, thank you very much. That concludes this video. So in this video, we've learned about importing alternative data to a research environment, and we're able to import both the US unemployment rate and the US initial jobless claims rate, and then test that with a linear regression against the S&P 500 and then against the small cap ETF. And then we're able to take that research, pick the best parts of it, and pull it into a framework algorithm that we could test against our benchmark. In this case, it was a small cap ETF, and we found that we could reduce the drawdown a little bit at the cost of the Sharpe ratio. Well, I thank you very much for listening, and I hope you've enjoyed this quick idea streams demonstration. If you have any thoughts or comments for next week, please let me know in the comments, and I'll be happy to pull them in and use them as seed ideas for the next idea stream. All right, thank you very much. Be safe out there, and chat to you on QuantConnect. Bye.